Okay, today we're going to talk about one of the most volatile commodity markets. In fact, it's known as a feast or famine market, the gold market. The gold market has very little in between. It's either moving sharply higher or sharply lower. It very rarely stays in one place for a long period of time. Even if you look at a chart over the last 5 or 6 years, gold has been trading in a relatively tight range, but it's gone up and down between that trading range in a very volatile manner. So just be warned that gold is probably the least friendly market to be in when you happen to be on the wrong side. In other words, there's no mercy for being wrong in gold. So make sure any trade you put on or any speculation that you participate in has a hedge or is at least small. With that said, the precious metals rally has been sparked by a relentless barrage of concerning headlines, tweets, but there's a good chance that most of the bad news is behind us. And if so, the gold rally could stall out or even reverse as buyers become scarce. Before we talk about the details of that, I just want to make sure everyone understands there's a substantial risk of loss in trading futures. It's not suitable for everybody. The reason we think gold may be a little long on the tooth here is if you look at a COT chart, this is the COT if you're unfamiliar with it. The COT is the Commitment of Traders report. It's issued by the CFTC, which is the Commodity Futures Trading Commission, once a week. The latest report came out on Friday. It was based on data that was collected on Tuesday of last week. So there is a lag of a couple of days. We kind of have to guess at where the market is based on market price changes and things like that. So to give you an idea, according to the latest report, which again was released on Friday but measured on Tuesday, there were roughly 290,000 net long positions in gold futures held by large speculators. Now, large specs are considered the smart money. They're big traders, they have big accounts, they're holding big size. So we like to pay attention to them. Now, it's the opposite of what you're probably assuming. We don't necessarily want to be bullish if the large specs are holding on to huge net long positions. In fact, it's actually the opposite. We have a feeling that all of the specs and especially all the big traders are already in the market. They're already long gold. And so there's a good chance that the buying will dry up simply because there's nobody left to buy. To put this situation into perspective, the all-time high in gold, which was in 2011, we saw about 230,000 to 240,000 net long contracts. Again, right now we're closer to 290 to 300 net long contracts. So the market is a lot more long today than they were in 2011 during the heyday of the metals rally. Also, if you go back to mid-2016, the all-time net long position in gold occurred at that time. Speculators were holding about 310,000, so we're not too far away from the all-time biggest net long position in gold that we've ever seen in the futures market. If you're wondering what happened in 2016, it wasn't pretty. Gold fell from about 1380 to 1120 in a pretty short period of time. So the premise is simple. There's a very good chance everybody that wants to be long gold is already in. And when you get into that situation, it doesn't matter what's going on with fundamentals or anything like that. You simply run out of buyers. And I think we may be getting close to such a situation. We also like to look at the relationship between gold and the US dollar. Normally, these two assets trade in an opposite manner. So in other words, usually when gold goes up, the dollar goes down and vice versa. We're actually seeing the exact opposite of that. They're both behaving in the same manner. They're both correlated. In other words, as gold's moving up, the dollar's moving up alongside it. You don't see this very often. These types of relationships can get out of whack like they are now on a temporary basis, but they rarely hold that change in relationship on a long-term basis. So that tells us that either gold has to come down or the US dollar has to come down, or maybe even both to varying degrees. If we take a look at a weekly chart in gold, it's extremely obvious just how overbought this market is. Sure, prices aren't anywhere near where we were in 2011, but let's face it, that was on the heels of the financial crisis, and we're just in an entirely different scenario here. I mean, the U.S. is still working on a decent economy. We're still expanding, although at a slower rate. We have low unemployment, so we're not anywhere near where we were in 2011. Yet, the gold market is as overbought technically now as it was in 2011. According to the RSI, which is an indicator we pay a lot of attention to, it's the Relative Strength Index. On a weekly chart, the RSI is over 70. It has not been over 70 since 2011. I think all of us remember what happened in 2011. Gold topped out around 1900, and honestly, it dropped $400 or $500 within a couple of weeks without really even looking back. So I'm not saying we're going to get a $400 to $500 drop in gold, but I think we could see $200 to $300. That's definitely not out of the question. That would just bring us back to where we were before all of this summer chaos ensued. You have to keep in mind, summer markets are illiquid. Weird things happen. Markets tend to be a little more volatile than usual. They get pushed around a little more than usual. So sometimes you can't always believe everything you see in a summer market. In our opinion, for this gold rally to continue, which we do not believe it will, we think the 1530-ish area will hold and prices will roll over. But if it were to continue, you'd probably need some sort of continuation of bad news, which maybe we'll get or maybe not. But more importantly, the market is pricing in several Fed rate cuts going into the end of the year and even starting in early next year. Although the Fed appears to be wanting to be somewhat accommodative, we doubt the Fed's going to be nearly as aggressive as the market expects it to be. And if that's the case, it should at least pause the gold rally or maybe even roll it over, as we suspect. If you want to learn more about reading charts or studying the COT report or any of the things that we've talked about today, gold seasonals, that sort of thing, you'll find all of this information in my book, Higher Probability Commodity Trading. You can purchase it on Amazon or any major book outlet. And if you're interested in learning more about trading commodities or our brokerage service, visit DeCarleyTrading.com. You can sign up for free newsletter trials. There's educational videos, educational articles. So the idea is we want to teach people what they're getting into, what they need to look out for. We want everybody to be educated before they ever decide to put their money on the line. We appreciate you listening. If you have any questions, please be in touch.